Welcome to the Chicago Board Options Exchange Options Forum. Now today we're going to study stock options with an emphasis on long-term equity options known as LEAPS. Now the name LEAPS stands for Long-Term Equity Anticipation Securities. As investors, are you looking for a less expensive way to participate in the price movement and potential profitability of stock ownership? LEAPS may be the answer for you. Trading volume in LEAPS options is growing as investors learn about the benefits provided by LEAPS, another investment innovation from the Chicago Board Options Exchange. Created by the CBOE in 1973, listed options have become a popular investment tool that provide investors with investment flexibility. LEAPS were created and introduced by the exchange in 1990 and provide investors with another exciting alternative to purchasing stock. In today's financial world, the flexibility provided by LEAPS can be important to investors such as yourselves because LEAPS can help you diversify your portfolio, they can protect your assets by guaranteeing a potential sell price, and they can increase your yield in a straightforward, simple way. LEAPS can extend these benefits as far as 3 years into the future. Both short-term and long-term options involve risk, and because of this, it's important for investors to understand the basics of options.
Now, options have been available for a while now, right?
Yes, in fact, they've been used since Roman times, first created by merchants to protect or hedge the value of goods being transported by ship. Business has changed dramatically since Roman times, but investors can still benefit from the versatile alternatives provided by options. Investment alternatives that can encompass the insurance-like protection of puts as well as the leverage that options provide.
Does the CBOE trade options on every stock?
No, the CBOE began trading listed options on 16 stocks in 1973, and the exchange now trades options on over 550 stocks, and the list has been growing every year. Other securities exchanges trade options on over 500 additional stocks. Long-term options, or LEAPS, trade on over 150 stocks. The list includes many blue-chip stocks such as General Electric, IBM, McDonald's, and Walmart. LEAPS are also available on several indexes as well.
I'm familiar with various investment strategies. Now, option strategies are no more complex than most strategies. Am I correct?
Options aren't hard to understand once you become familiar with the basic fundamentals. And that's what we're going to do today. Teach you the fundamentals of stock options and LEAPS. Any questions before we begin?
Yes. You call these listed options? Now, what do you mean by listed?
Good question. Options that trade on any national exchange are called listed options. The exchanges are regulated by the Securities and Exchange Commission. Listed option contracts have standardized terms and are cleared by the Options Clearing Corporation. Investment firms sometimes create option contracts that have non-standard or negotiated terms. Those are called over-the-counter options. We're discussing only listed options today. All right, let's start with a quick look at the definition of options. An option contract is a security that gives the buyer the right, but not the obligation, to buy or sell a particular asset at a fixed price for a specific period of time. The contract obligates the seller or writer of the option to deliver the underlying security, or in some cases cash, if the contract is exercised by the buyer. Okay. Let's go over this for a second now. We have two types of options: calls, which give the buyer the right to buy stock, and puts, which give the buyer the right to sell stock.
I understand the rights of the buyer, but could you explain the obligations of the seller?
Well, sure. Let's take a close look. The option buyer has rights, and the option seller has obligations. An option buyer, the holder, has purchased an option contract on an exchange, right? An option seller is obligated to fulfill the option contract if a holder exercises the option. A buyer is long the option, and the seller or writer is considered short.
So, fixed price refers to strike price?
Yes, the price at which the stock must be sold or purchased if an option is exercised is called the strike price. A call with a strike price of 50, if exercised, gives the buyer or holder the right to buy the underlying stock at 50. The seller is obligated to deliver the stock at a price of 50. A put with a strike price of 50 enables the holder to sell stock at that price, and the put seller is obligated to buy the stock at 50. Options trade at a variety of strike prices generally in increments of $5 for traditional options and $2.50 for LEAPS at a variety of expiration dates.
Now, both strike price and the expiration date are agreed upon, aren't they?
Right. At any given time, options on a particular stock are available with several different expiration dates. They generally expire at 3, 6, or 9 months, or in the case of LEAPS, 1, 2, or 3 years. When you buy or sell an option, you pick the specific expiration date. Let's review a bit before we move on now. Option contracts establish an agreed-upon strike price and expiration date and give the call buyer the right to buy the stock at that price, and the put buyer the right to sell the stock at that price until the option expires. The call seller is obligated to sell stock at the strike price if the option is exercised. Similarly, the put seller is obligated to buy stock at the strike price if the option is exercised. All right, let's move on to some detailed examples. Any questions?
Yeah, you've mentioned the transaction. Is this actually an agreement between two individuals? I thought the exchanges serve as the intermediary, right?
Good point. The transaction does take place between the representatives of a buyer and seller. However, when it comes to the actual contract, it is with the Options Clearing Corporation, which acts as the intermediary or coordinator of the process, so that an investor does not have to worry about the identity of the party on the other side of the transaction. The OCC was established by the Chicago Board Options Exchange and is now owned by all of the option exchanges. The OCC was established as a way of matching the buyers and sellers, particularly when an option is exercised. To date, every option exercised has been completely fulfilled. I mentioned exercise prices, which are also called strike prices. Let's take a close look at option strike prices and quotes. And once we've reviewed these concepts, we can move on to option pricing factors and then on to strategies. A strike price is the price at which the holder of an option can purchase, in the case of a call, or sell, in the case of a put, from or to the option seller. All right, let's look at an example. You can see on the screen here ZYX, which is trading at $60 per share, and the various strike prices with respect to options which currently trade on the stock.
Why are there so many different strike prices?
Options provide investors with flexibility, and the numerous strike prices are an example of this. Basically, we have 3 types of strike prices: in the money, at the money, and out of the money. The values or prices of the 3 types tend to react differently to the movement of the underlying stock. With in-the-money calls, the strike price is below the stock price. With at-the-money calls, the strike price is at or near the stock price. And with out-of-the-money calls, the strike price is above the stock price. Does everyone understand this?
Then an option's strike price and value in relationship to the underlying stock could vary from day to day, right? So something that is at the money today could be out of the money tomorrow.
Exactly. If the stock price is changing, so too will the option's relationship with the stock. You've made a good point here. An option's price and the ingredients which make up its value are always changing. Understanding these relationships and how they change as the stock price changes will help you become an educated option user.
Each strike price effectively provides different profit and loss opportunities to the buyer. That's why the prices vary.
Correct. Let's take a closer look at option prices now. Since an individual option contract relates to 100 shares of the underlying security, listed options have a multiplier of $100. Therefore, the price of 7 translates into $700, excluding taxes and commissions, $100 per point. And we're talking about the right to buy or sell 100 shares per option contract. Additional transaction costs are omitted during our discussion today, as are commissions and taxes, all right? Question, which calls are out of the money?
Calls with strike prices above 60.
Correct. Which puts are out of the money?
The lower cost put options, the 50s and the 55s.
Exactly. Now that we understand a little bit more about how options work, let's take the next step, exploring option pricing. Any questions?
Yeah, the multiplier is $100. That means if an option moves from 4.5 to 7.5, the holder of a call makes $300, right?
Yes, but remember, commissions and taxes must be considered as well. But you're right, 1 point equals $100. Let's move on now to option pricing. We're going to examine the factors that impact an option's price in order to get a better understanding of how options are priced. Mary, do you have any ideas as to what factors could influence price? What are the key variables?
Well, let's see. We're talking about a contract with a specific expiration date. So I think time would certainly be one of the components.
Right. Time is one of the key components. What else is important?
Clearly, the price of the stock is a key factor. It would have to be a critical issue in the options price, right?
Good point. Stock price is very important. As expiration approaches, this variable is the key determinant of an option's price. Other issues factor in and are especially important when it comes to pricing LEAPS. What do you think they are?
Well, as an investor, interest rates and dividends are quite important to me. I think they both would have a lot to do with the pricing of options.
You're exactly right. Current and anticipated interest rates and dividends are two of the key pricing variables. Cash dividends are distributed to shareholders of the underlying stock. Option holders do not receive dividends unless they have exercised the option to buy the stock prior to the ex-dividend date. Interest rates are central to the pricing of most investments, and options are not an exception. Dividends and interest rates. Good job. Any other forces?
Strike prices, definitely. This is the key determinant in terms of when an option has value. It has to be the most important.
Well, great. We love your enthusiasm. Yes, the exercise price of the option plays a key role. Much of the value of a specific option and how its value changes will depend on its strike price. Let's add this to the list. Strike price. Okay. Now, we're all familiar with insurance products and are comfortable with the decisions we have to make in terms of deciding the amount of insurance we need and the level of deductibility we'd like to have in place. Strike price decisions can be compared to the decisions we're familiar with from the insurance arena. We're searching for one more variable. It's a bit more complex than each of these, but when you hear what it is, you'll realize that it could be a significant pricing element. Any ideas?
How about stock splits?
Well, that's a good guess, but no, option contracts are generally adjusted for stock splits, and therefore splits will not play a key role in the prices. Our missing component is the volatility of the underlying stock. When you think about it, a stock's historic volatility, defined as a measure of stock price fluctuations, is pretty important. Mathematically, a measurement of volatility is the annualized standard deviation of daily returns. This number is described as a percentage. A stock with a volatility of 10%, let's say, is statistically likely to move in a range of plus or minus 10% of its price over a one-year period. A $100 stock with a volatility of 10 will therefore have an expected range of 90 to 110, about two-thirds of the time. The stock can certainly move beyond that range, but two-thirds of the time, its stock price is anticipated to be within this range the entire year. If the volatility changes, this range will change, of course. The fact is, higher volatility produces higher option prices. Volatility. Because of the greater likelihood that the stock will move in a wider range. All right, now that we have a list of pricing elements, and I think have developed a sense of why they play a role in the pricing of options, it's time to move on to discussing option strategies and the exploration of how LEAPS can be used to implement these basic strategies. How do we transform our opinions on the direction of a stock into an option strategy? Earlier I mentioned that options are flexible. This means that they have a variety of uses, with each use designed to meet a specific investment need depending on your view of future stock price movement. Keep in mind that you must have a view as to what's going to happen with the stock. You need to have an opinion on the stock. Are you bullish? Are you bearish? Or are you neutral on the stock? Equity options provide you with additional flexibility to manage your stock investments even when you are neutral on the underlying stock. Neutral is now an opinion, thanks to listed options.
Okay, I'm bullish on ZYX. Will you demonstrate how the call options could be profitable if the stock price rose, say, 10%?
Okay, A 10% move would put ZYX at 66. Let's look at a profit and loss chart with the stock at 60. Here's how this would look. If you had purchased the at-the-money call option, in this case the 60 strike price, and the stock moved to 66, at expiration the call would be worth 6. This chart shows that if you paid $4 for the call, you would begin profiting above 64 at expiration. The in-the-money call with a strike price of 55 would be valued at 11 at expiration if ZYX moved to 66. The value is determined by subtracting the strike price from the stock price. This chart shows that if you paid $7 for the call, you would begin profiting above 62 at expiration. Or if you had purchased the out-of-the-money call with a strike price of 65, remember we're still at 60, so the 65 is out of the money. This call would have a value of 1 point at expiration. This chart shows that if we paid $2 for the call, it would not be profitable unless ZYX rose above 67 at expiration. As you can see, the option price movement and the profitability of each option varies with the strike price. Keep in mind that we're computing the values based on holding the option until expiration. This shows each different strike. Each one has moved differently. The in-the-money moved up about 60%. The at-the-money moved up 50%, and the out-of-the-money lost 50% because the stock did not rise above the break-even level for the 65 call. We have to keep in mind that when you purchase an option, there is the possibility that it will expire worthless. At expiration, if the stock had declined below 55, each of these options would expire worthless in our example. This points out the downside of leverage. If an investor is wrong about the direction of the underlying stock or wrong about the timing of the anticipated movement, the investor could lose 100% of the investment relatively quickly. Option investors must be accurate in their projections of stock price movement and, importantly, correct in their estimate of when the anticipated movement will take place. How about another opinion?
Well, I would disagree with your bullish sentiment on ZYX. I would be a put buyer. I am willing to back up my view with a options investment. What should I buy?
Great, a diversity of opinion. Let's take a look. Let's price the in-the-money, at-the-money, and out-of-the-money puts. Okay, and then I'll ask you to pick one. The at-the-money put, the 60, is priced at 4.5. Puts and calls with a strike price of 60 are both at the money, with the stock at 60. The out-of-the-money put, the 55, is priced at 2.5, and the in-the-money, the 65, is priced at 7.5. How bearish are you?
Very. I'll buy the 65 put.
Okay, but what type of move in the stock are you counting on? We need a percentage.
I'll go 25.
Okay, he's serious about this. This would place ZYX at 45, and your put would be valued at 65 minus 45, or 20 points. Good job. The at-the-money put would have a value of 15, and the out-of-the-money put would have a value of 10. Again, each option moved a different percentage. On a percentage basis, the out-of-the-money has moved the most, but it's also the least expensive, but does require the largest move in the price of the stock to have any value at expiration. Puts are often compared to insurance on your stock. With a variety of strike prices, the option investor gets to decide what level of deductibility he or she would like. In other words, at what level should the protection begin? Again, our prices are computed at expiration.
You mentioned neutral earlier. How does that work? I thought you had to be either bullish or bearish.
Let's take a look. Here's a chart that depicts the profit and loss scenario which the typical stock owner faces. As I said, when the stock moves up, the investor makes money. When the stock drops, the investor loses money. Now, let's take another perspective. What if the investor who owns stock in the company has developed a slightly less bullish view? that the stock might sit still for a while or do nothing, move sideways, vacillate in the small range, the investor becomes somewhat neutral on the stock temporarily. Not wishing to sell the stock outright, he decides to protect the investment and increase revenue by selling out-of-the-money call options. Remember, an option seller receives the option premium. This is called a covered right when the seller owns the underlying stock. A covered writer sells options against stock. All right, what's happened to the profit and loss curve for this investor?
It flattens out.
Exactly. Let's take a look. It flattens out because at a certain point, the option price will begin to move approximately 1-to-1 with the stock price, neutralizing the price movement, profitability, and potential.
Well, what if the option holder exercises the option? The stock gets called away from the option seller, right?
Correct. If exercised, the covered writer would have to deliver the stock, meaning sell the stock at the exercise price. Writers generally try to sell out-of-the-money options at a strike price at which they would not be unhappy selling the stock, if it was called away. If the option expires below the strike, the seller keeps the premium. If exercised by the buyer, the seller keeps the premium and sells the stock at the exercise price.
What if I develop a less than positive view of the stock? I do want to take some of the risk out of my stock investment, but I still want to be in the game if the stock should soar.
All right, you could buy protective puts. Puts could provide you with downside protection without giving up the upside potential. But as an option buyer, you'll be paying a premium for that protection. Stock owners who are put buyers will be protected until the option expires. Of course, the options will expire worthless if the stock remains above the strike price at expiration. Let's take a look. This chart demonstrates the profit and loss scenario of buying a protective put. Protection begins at the strike price.
Oh, I get it. You pay for the right of protection with the put and don't give up the upside potential of the stock except for the premium.
Exactly. Keep in mind that option strategies and outcomes, especially those involving stock assignment and stock hedging, could have a significant tax impact. It's important for option investors to have a thorough understanding of these issues, and we recommend that you review these issues with your investment and tax advisors. Any questions?
Yeah, we've discussed the many benefits of regular term options. Now, do these benefits also exist for long-term options? I'm talking about LEAPS.
Yes. In fact, the benefits and features of regular term options are shared by LEAPS, but LEAPS also provide a few additional benefits, important benefits that are especially relevant to stock investors. Many investors who have not invested in options before have started using LEAPS. The benefits are simple to understand and provide investors with an exciting new alternative to stock ownership. LEAPS are simply long-term options. The contract specifications are essentially the same except for the strike prices and expiration dates, and of course, option symbols.
Why were LEAPS developed?
LEAPS were developed to provide the benefits of traditional options, but with a longer-term view. And this means slower initial time decay compared to regular term options. Time decay is a term used to describe how the theoretical value of an option erodes or reduces with the passage of time. As we extend the period of time to expiration, the speed with which options erode in value is slowed down. More gradual time erosion is the key benefit to LEAPS. This chart demonstrates postponed time erosion.
Now, if the features are similar to regular options, are the uses and strategies identical as well?
Option strategies using LEAPS are fundamentally the same as using regular term options, but a couple of additional investment strategies exist as well, pivoting around the best features of LEAPS.
Well, what would be a reasonable use of LEAPS for a stock investor familiar with risk-taking but new to options?
Well, buying LEAPS calls as a stock alternative is a strategy that provides the long-term stock investor with a reduction in the maximum amount per share that can be lost. Yet, it is still a long time frame investment that in many cases performs in a manner similar to a stock purchase, but with less capital involved. Let's look at an example. This chart shows LEAPS alternatives for ZYX.
How would we select the right strike price for this strategy? Short-term options feature a variety of strikes. Are LEAPS the same?
Well, LEAPS generally are introduced with one in the money, one at the money, and one out of the money strike price. As the stock moves up and down in price, additional strike prices may be added. So to answer your question, fewer strike prices do exist initially, but the stocks will always have these important option strike prices. When it comes to selecting a strike price for the strategy we're talking about now, LEAPS as a stock alternative, it's generally best to select an in-the-money call option.
That, of course, would be the 55 strike. That would be the most expensive option up there. Why is that the best choice?
Well, you're right, it is the most expensive in terms of price, but if we look closely, I think you'll see why. Does it have more intrinsic value than the other strikes? Intrinsic value is the amount of the option's price that is in the money.
Oh, so that means that more intrinsic value means that the call price movement will be more in line with the stock price movement than the at the money and the out of the money. If I have this right, that means that as the stock price moves higher, the option price movement should reflect that. Am I correct?
Yes. In-the-money LEAPS work well as a stock alternative because the in-the-money options generally will move with the stock in terms of price movements. In-the-money LEAPS also have less time premium than the other strikes. Time premium is the portion of the option premium that is not in the money. Here's a profit and loss chart for this option. The break-even level for the option at expiration will be 67. What's the key difference now between these two investments, stocks versus LEAPS?
The cost, and therefore the downside risk.
To some extent. For the bullish stock investor, LEAPS can work well as a stock alternative. For a buyer, the risk is limited to the premium paid for the option. I should point out here that we're talking about purchasing LEAPS in proportion to the number of shares you would normally purchase. If the investor is looking to own 1,000 shares of stock, this is equivalent to 10 LEAPS. This means that as an alternative to investing a large amount of money on a stock purchase, the investor is investing a fraction of that amount in options. Keep in mind, the use of leverage also has a potential downside. If the underlying stock does not move in the anticipated direction, the option buyer could lose all of his investment, or at least the portion that is not in the money. The movement also needs to take place during the life of the option contract. Look at this. A stock owner has $60 at risk. If the stock price declines substantially, the stock owner will suffer significantly. The LEAPS owner only had $12 at risk, and due to the extended lifespan of the option contract, if the stock drops, the option premium would most likely continue to contain time premium. Therefore, the option premium would most likely not drop to zero, even on a big movement in stock. Remember, we're talking about LEAPS buyers here. Sellers face additional risks. The LEAPS investor also could earn interest on the remaining capital. The funds would be earning interest instead of paying for the stock. This additional interest income is another key benefit to using LEAPS as a stock alternative.
Wait, what's the catch here? There has to be some negatives attached, right?
Good point. LEAPS ownership is not identical to stock ownership. Stock owners often receive dividends, right? LEAPS holders will not. It's important for LEAPS users to be aware of this. Additional cash dividends will only benefit the stockholder. But stock adjustments often result in adjustments to the option contracts, according to OCC guidelines. Also, LEAPS have a lower cost, right? Well, there's always a trade-off for reduced risk. At expiration, the LEAPS call owner will only make money if the stock is higher than his strike price plus the amount paid for the option. This is the trade-off for the benefit of only losing the amount of the premium should the stock decline significantly in value. This means that an option may expire worthless. If at expiration the option is not in the money, it will have a value of zero. This is the downside of leverage. If the anticipated stock movement does not take place, an option owner can lose all of his or her investment.
A portion of the option premium reflects the intrinsic value or in the money amount. The balance is the time premium?
Yes. In this example, the option price was 12. Intrinsic value was 5, meaning the time premium was 7. Generally, the portion of the premium that is not intrinsic value is called time premium. The at the money and the out of the money could also be used in this strategy, but with higher entry points for a lower cost. The at the money is priced at 9 and the out of the money at 6. Neither of these have any intrinsic value. Basically, the premiums are 100% time premium. The break-even for the at the money is 69, and the out of the money is 71. This is calculated by adding the premium to the strike.
Premiums vary with the strike price.
So, when we review the risks, the in-the-money leap is the best alternative to stock for the bullish investor who thinks the stock will move higher and is using the leap option as a stock substitute.
Yes, and how about the at the money?
The at the money is for the long-term investor who's prepared to pay a higher time premium and to participate in higher stock price levels, or higher time premium than the in the money but lower option cost.
Exactly. And the out of the money is for the more aggressive investor who thinks the stock could make a significant move higher and would like to participate at that level. Lowest cost of the three, but also the highest break-even. The out of the money offers the most leverage. Remember, most options don't have to be held until expiration. For the purposes of our discussion, we've priced options at expiration. But option prices will fluctuate and can be bought and sold prior to expiration. Option prices will move up and down during the life of the contract. Questions?
Yeah, I've owned a few stocks for a long time and wish to keep them, but could I protect my profits using LEAPS puts? There have been periods of time when I would have paid for the protection just to sleep better at night. Long-term options might fit my investment style. Does this make sense?
Definitely. Puts provide protection for a predetermined premium. This enables an investor to plan for the future with certainty. And to your point, sleep better at night as well. Investors are familiar with insurance products. Puts are effectively stock price insurance.
As a stock owner, do you give up anything to hedge your stock using LEAPS puts?
Only the price of the option, which you know ahead of time. You'll retain all of the benefits of stock ownership, dividends, splits, and stock price movement. Remember, as a holder of an option, the most you can lose is the premium, and you own a right as opposed to having contracted for a potential obligation. Of course, if the stock drops in value, the stock side of your investment will suffer. Let's take a look at our three basic alternatives in, at, and out of the money puts.
To hedge, we have to decide at what level or price we wish to hedge, right?
Yes, this has been compared to the decision-making process that goes into selecting insurance deductibles. What's the value? And how much of the value do you wish to protect? At what level? Which means to us, which strike price? With ZYX, we have a few choices to make. The at-the-money 2-year put is priced at 9. The in-the-money put is priced at 11, and the out-of-the-money is priced at 7. Pick one.
Well, if I were nervous about the stock, I'd buy the at the money. See, we may have had some pretty nice profit here, and that would pay for protection. And for 2 years of protection, well, that's not too bad, especially since we still keep the dividends. I mean, we could let the dividend stream pay for the downside protection.
Good point. Let's say this industry falls apart and the stock drops 33% next year. At 40, the 60 put would have a value of 20 points due to the protection purchased by the put buyer. Remember, he has purchased the right to sell the stock at 60. The investor is out 20 points on the stock, but earned 11 points on the hedge at expiration. 20 points less the 9-point premium.
And of course, the in the money and the out of the money would have provided different levels of protection. We could select any strike.
Yes, at least among the strike prices being offered. It's the put buyer's choice. The decision-making process should include a review of the cost of the option and the level at which the protection kicks in. With LEAPS, time decay is less of an issue than with regular options for purchasers. LEAPS buyers will find that LEAPS generally retain their time value longer. This is because the option has a longer life. Stock owners, or covered writers, who have sold calls against their stock may use the same strategy with LEAPS. Writers are generally looking for the additional return provided by the receipt of the call premium, but in doing so, give up the upside potential of the stock if it rises above the strike price. LEAPS could provide the covered writer a long-term opportunity, but covered writers must be aware that the option might be exercised, and if so, they're obligated to deliver or sell the stock to the call option holder at the strike price.
Well, what about the other factors? Rates, dividends, volatility. I mean, are these less important or more important?
LEAPS are sensitive to any investment assumptions that could impact the option's value during a long period of time. The LEAPS investor should be aware of pricing issues as related to dividends, interest rates, and volatility. Dividend changes could impact LEAPS value significantly due to the fact that LEAPS contracts cover an extended period of time. Interest rate changes also will impact LEAPS prices. Predicting rates over a 2-year period of time can be challenging. Interest rates are a significant factor in the pricing of LEAPS. Earlier, we briefly mentioned that volatility plays an important role in the pricing of regular term options. Volatility plays a greater role in the pricing of LEAPS, since there is a longer period over which the stock price can fluctuate. Please keep these considerations in mind and review them with your broker or investment advisor. We've been talking about option strategies involving the purchase of options or the covered selling of options. These strategies generally involve predetermined risk. Uncovered option sellers face additional risks, which are significant. An investor who sells uncovered calls has significant risk because he's obligated to sell stock at a strike price which may be lower than the current price of the stock at the time of exercise. Uncovered put sellers are obligated to buy stock at a price which may be higher than the current stock price level at the time of exercise. Uncovered option sellers therefore face unlimited risk for a limited gain equal to the premium of the sold option. Investors should review these risks with their broker or financial advisors prior to selling uncovered options. Well, we've covered quite a bit of territory today, encompassing the features and benefits of equity options and long-term equity anticipation securities, known as LEAPS. LEAPS provide the defined limited risk benefits for the option buyers shared by regular term option buyers. But the clock isn't ticking as loudly, with expiration dates as far as 3 years out. The option investor extends the life of the option, and this means extending the time frame during which the investment opinion or view can be realized. This is the key benefit of LEAPS. The characteristic of gradual time decay plays an equally important role in option selling strategies, and investors should review these strategies with their broker or advisor. Remember, our examples discussed today did not include cost related to commissions, fees, and taxes. These charges may impact your investment decisions and should be reviewed with your broker or advisor prior to investing in options. Also, we've tried to keep things fairly simple and straightforward. Your broker or advisor can help you develop the strategy that meets your actual needs. Options involve risks and are not suitable for every investor. Prior to buying or selling equity options or LEAPS, an investor must receive a copy of the option disclosure document called Characteristics and Risks of Standardized Options. This document is available through your broker or from the Chicago Board Options Exchange. You may also call the CBOE at 1-800-OPTIONS to receive a list of LEAPS stocks and symbols.